Wealthies, welcome back. If you're new here, this is All the Wealth, WealthMore's wealth building channel. And I'm Mical Jeanlys-White, the founder and CEO. And today with me is our portfolio strategist, none other than the amazing Matthew Levy. Matt, welcome back. We
Thank
are
you.
here today. Yeah, it's so good to have you because last week when we were planning this episode, we thought it would be kind of,
Super
quiet,
easy, super
super
quiet,
easy.
relaxed. Never is.
Nope, but it's not. Guys, we're here today to talk about a quick look back at how the markets did in 2025. But we want to jump right in and talk about 2026. So much has already happened. You've got Venezuela, you have Greenland, we still have inflation. The Fed chair is under investigation. Our leaders, as we speak, are in Davos right now for the World Economic Forum. And President Trump is talking not only about US economics, but global themes all around. This could not be a more exciting time in the market. But I also understand for some of you guys, you might be like, no, it's not exciting. It's a pain in the ass.
It's that's one way. One way I was going to say that's one way of putting it. It's funny. In all my years of investing, there's always something going on like this, and we call it the wall of worry that the market needs to overcome. So if this isn't a wall of worry, I don't know what is.
Exactly. But then the numbers don't lie. So, Matt, how do we do in 2025?
Yeah, so it's one of those that the headlines in the economy is not the stock market. We've talked about that a number of times. Last year, the S&P 500, which is a good barometer for U.S. Equities, was up over 16%. It did extremely well, and that's on back to back to back positive, very positive years. I think in the last 3 years, the S&P 500's up over 80%, which is got to be some close to some sort of record in terms of a 3-year return. Tech stocks did great. The NASDAQ was up over 20%. And this was all in a year where we came into the right after the first quarter thinking we were going to be finally in for a down year. We saw with the tariff tantrum back in April in 2025, and we talked about it a little bit before this, was the markets were down, 20% at one point. They were down 12% in a week. And, if you go back and look at some of the headlines during those times, you wouldn't say, oh, we'll probably get 16% return this year. There's no way. So, on the whole, really, really good year for stocks and equities, and also some other areas, which we'll touch about later too.
Yeah, I want you guys to take that in, right? For folks who are like, put your money on the sidelines, there were so many headlines last year about, should you be pulling your money out of the market? And we end up with the S&P up 16%, NASDAQ up 20%. So again, I want you guys not falling for the fear mongering. The fundamentals don't change. This is about companies, consumers. If the consumer is spending and the US consumer did well, the consumer is still strong. We had record high December spending, the highest in like 5 years.
Yeah. Yeah. No,
No one
it's
thought that would happen.
Yeah, and we do have to give the retail investors some credit too. Like we saw in April last year, retail investors were right in there buying the dips and looking for things like this. We saw something like $3 billion plus in one day on April 3rd last year when the S&P was down 5% that day. So we're finally seeing like the retail catching up to, invest for the long term, take these discounts as a time to use your money that you might have on the sidelines, or find a way to save some more that month so you can invest for your future too.
Yeah. Yeah, before we started rolling the cameras here, Matt and I were like, look, if you can invest in 2025, you can invest in any
Yeah.
year. 2025 had to be the most unprecedented year in terms of tariffs, inflation, so many things happening in our global markets, US policy impacting the markets, and still you end up with record highs across the board. And I
Yeah.
can't emphasize this enough because you were not going to do better if your money was sitting in a checking account, savings account. You were not going to do better if you were chasing T bills and not being smart about investing and having a diversified approach. And here we are going into 2026. Started this with all the stuff in the news. It's going to be another interesting year, but the fundamentals don't change.
That's just it. And we always had a way of thinking about it was like, regardless of what's going on with all this headlines of, you know, in Davos and the Greenland and, Venezuela and all that stuff, it's like you're still going to go and, buy toothpaste or brush your teeth, right? So what do? You invest in companies that are still going to sell that toothpaste to you. You invest in like a Colgate or something like that. And for us, our strategy is really to remain diversified and kind of invest in a basket of good companies based on, your risk tolerance, your investor risk tolerance, and your objectives. And if you keep that in mind long term, that's going to be where you really work on that compounding over time. So you're not going to be, you know, dropping 50% in a day on one stock or all your money in one stock. Your portfolio is not going to drop like that. You want to be invested in a number of areas where you can balance that out long term, if that makes sense.
Yeah. Yeah. So speaking about diversified portfolios, let's go into our own WealthMore portfolios, which I have to say there's a lot of pride around here about how well these portfolios did last year. But I won't steal your thunder, Matt. You tell us.
Yeah, we're super happy with how things worked out. We'll start with our most conservative portfolio. So for those of you who are maybe either a little bit older or you need to save your money, it's more about preservation and income rather than wanting to grow for the long term. With our conservative portfolio, we actually gained over 8% around there in that portfolio. The result of that was because bonds had a really good year. So, we have the Federal Reserve lowering interest rates. When you lower interest rates, bond prices go up, which means your returns are going to go up. So we're happy with that. With the conservative investor, you want big years like this because that can really set them up long term. Because normally they don't get that high, right? If you're really trying to just preserve your money, you're not going to get 8% every year. So we're happy with that. The next two we have is the balanced and the moderate portfolio. Those two came around 14%. The moderate did a little bit better than the balanced. We had a good allocation to US and international equities. International equities did amazing last year. We also, in all of our portfolios, we maintain an allocation to gold and precious metals. And gold and precious metals last year just went bananas with everything going on. So that really helped lift the portfolios up on that side. Again, the moderate and the balance, those are supposed to be more not conservative like the other portfolio, but they're supposed to be more balanced, right? They're supposed to, hence the name balanced and moderate. They're not supposed to blow the lights out. They're supposed to give really consistent long-term returns, work on that compounding. And yeah, they did great. So we're really happy with that. And then
Yeah. I
finally,
want to
oh,
double click right here, Matt, on the
yeah, sure.
balance, right, because I can't stop preaching about how the S&P 500 is not diversified, and it is now like over 50% tech influences that, right? And it's Mag 7, the big tech companies, which all sort of move together. And yet here we are giving folks a balanced view of investment.
Yeah. If we even look back at the S&P, like the Magnificent Seven, and just Nvidia alone accounted for like 15% of the S&P 500 return last year. Think about that one stock, 15% of the whole index. Like that's a little bit, you know, a little bit
Yeah.
wild.
Yeah.
And then if we strip out big tech, or if we look at like an equal weight index, so another thing we like to look at is it's called the S&P 500 equal weight. So they take every company and give them the same percentage, uh, for instead of being market cap weighted, which is what the S&P is. That gained about 11% last year. So that would be a more diversified projection of what we would expect. I'm super happy. We're super proud of how those balanced portfolios performed because we also had fixed income in there too.
Exactly. And I look at investment from you guys out here, you're busy. You have jobs, you're balancing your whole work-life balance. No one expects you to be Matt watching the markets, having licenses, degrees in this, right? My peace of mind comes from a platform like WealthMore, knowing that I'm investing and there was a portfolio strategist looking at this who's making the right decisions, and I can go off and do this and run WealthMore. And the peace of mind, that's what we're offering people. You shouldn't have to become a portfolio strategist. You should not have to become an economist and watch the markets all day. You have other things to do. Having the right investment strategy, having the right financial advisors is to take that load off of you. When I used to do this on my own, every swing in the market, I was like, oh, I got to log in, see. Now I'm like, no, I'm good,
Yeah. Yeah. It's kind of like the last 2 days. I wish I had other things to do.
right?
Yeah.
Exactly. Exactly. And then our last one, the aggressive growth one.
Yeah. And again, this is more for those investors who are wanting to, maybe they're younger, maybe they have a nice nest egg already saved up and they want to really grow their money for, generational wealth or retirement or whatever, but they have the time to invest in a higher equity exposure portfolio, more stocks, more tech, more international equities, still have that gold. This one did about 23, just over 23% last year. So, we're very pleased if we can outperform the S&P, the Nasdaq, and all those things. It's a good year, but not to toot our horns so too much. We have a science behind it. We want to make sure everything's diversified properly, and we're in the areas we want to be. But we're not like overexposing ourselves to any one industry or anything like that.
Yeah, we are not chasing alpha, right?
Yeah.
We are not out here looking to time the market, beat the market. No, we are here for long-term wealth creation. The number one job is to not lose money, right? As Buffett would say, like, your number one job is to not lose money. And we take that quite seriously in terms of being smart, deliberate, looking at the markets, not just US, globally, making sure they're balanced so that, our Wealthmore members can do better. That's our job.
Not lose money over the long run. I'm sure, we will see swings for sure. It's part of investing, it is what it is.
Absolutely.
Yeah.
Absolutely. So, Matt, here we are. It's Jan 21st. We're only 21 days in the year. It's already packed filled with excitement. Before we started recording, I told you, hey, I'd never thought I'd have so much fun in such a
Yeah.
every day is a new story in the market. But here we are because, again, taking a strategic look at the market is the way to go.
Yeah. For us looking out to 2026, we've got a Federal Reserve that's being accommodative. They lowered interest rates last year a few times. I wouldn't say they're easing, so they're not letting the money flow, letting the economy run hot quite yet. But they're not restricting it either. They're kind of in their neutral mode. Whether we'll see them cut more rates this year or not, I'm not so sure. I think they may stay steady for a while unless we see some sort of economic shock or some sort of other geopolitical shock. Who knows? But that should stay kind of in the green zone, as it were. The economy is looking pretty good. People are spending money. For us, we're pretty positive on the stock market and investing throughout the next few years. The AI trade is definitely a little bit overheated. We're keeping an eye on that. Technology doesn't just go from the lower left to the upper right in the stock market forever, but we don't want to be too you know get away from it too much either. It's a big secular change that's happening in the industry that we think will have increasingly good margins. There's lots of companies that are doing really great things. Yeah, I'm pretty positive on markets, and I think that we're in a pretty good spot. We're due for a correction, a pullback, or something like that at some point. They always come. We're not naive. But as we saw last year, the correction down and the snapback after can be just as quick. So as long as we stay true to our strategy and invested, and we should be okay.
Yeah, yeah. And I'm always gonna explain these terms or remind you guys when we say correction, we're talking 5 pullback, 10%, not what at times for some investors might interpret that to be a much bigger number, right? So we wanna
Yeah.
always mention that because we don't want you guys falling for, like, the fear mongering or the clickbait out there.
Yeah, and there's a lot of it. And it's just
Tons of it.
been it's kinda crazy because now you also see all this AI produced content that will also, influence your behavior and look at that too. So just keep a, grain of salt out there and make sure you're not getting too emotional about investing, as much as everyone is, and we can get easily emotionally tied to money. It's really more numbers and science and math, and that's what you have to fall back on for sure.
You got it. And certainly cooler heads prevail.
Yeah.
Cooler heads prevail. I would not advise going out there and doing things when you're highly emotional about the markets and what's happening and you don't have a good backpack of information. I'd prefer you call your wealth advisor, talk to them, email us, reach out to us, and we can help you and walk you through sort of what we're seeing in the market. On the AI front, WealthMore, we're building our own AI wealth coach, which you guys can go to wealthmore.net and play with the beta out there. But what that meant for me is having a sort of line of sight into how these tools work because we're building our own, how these models work, where some of the challenges are. We can see these headlines and know whether or not they're fluff because we're also building using the same tools, you name it, be it OpenAI, Gemini, these sort of larger LLMs, and building an application layer on top of it with your wealth advisors, training the model so that it can help you guys. We're able to sort of look at some of these headlines and know when, hey, are they reaching? Is it true that, AI is going to replace all of us? I can tell you today where it sits, no.
Yeah.
Yeah,
Yeah. People need people. It's what makes us
absolutely.
human.
Absolutely. Not to mention the thing just loves to hallucinate.
Yeah, for sure. Yeah, I've can counted many times where I'm just like, that's not
That's not
correct.
true.
Yeah.
Got it. And, hallucinate on my food choices or my fashion advice, but let's not
Yeah.
hallucinate with money.
Yeah, it might be
Not my
fun to have your outfits chosen by AI for a full week, see what happens.
it happens, right? But I don't know if I want it picking my investments when it hallucinates and still struggles with basic math.
For me, I was just gonna say, like, a few things for me to just keep in mind, back of your mind this year with everything that's going on. If we stay diversified properly, concentration can cut both ways, right? If you're concentrated on the upside, it might be great. On the downside, it's not gonna feel so good. And we always talk about kind of aligning your investment, your risk tolerance, and your objectives with your real life, with what you're trying to accomplish, right? So speak with your advisor and make sure you know what those are properly before investing in the markets. And then, just stay invested. That's the biggest thing. Stay invested over time.
You got it. And I also want you guys to think about Q1. Many of you guys are getting bonuses, tax returns. That's cash that's coming in, and it's a great time to think about how to strategically put that cash to work. Um, Regardless of the day your bonus or your tax return hits, if the market is up or down, just really think about, hey, how can I use this capital and allow it to help me build longer term wealth and frankly maybe even habituate that. I know that's always been one of my own personal strategies is to not let a good like cash inflow go to waste.
For sure. And if you're worried, I always get this question. It's like, should I invest now? The market's like near its high. It doesn't seem like a good time. If you look 10 years from now or 15 years from now and you think back, oh, on January 22nd, 2026, I didn't invest because I thought the markets were high. Meanwhile, that's, 80, 90, 100% ago. It's not going to feel so good. Whereas if you just get it working for you, just think of it as like, I'm putting this money in and I'm gonna watch it grow for 10 years.
Got
That's
it.
really the idea.
Yeah. Yeah. I can't, you know, we're always going to tell you guys the key. And I know it may sound boring, like, "Oh, here they go again with the get
Yeah.
started and investing." I know sometimes I feel like a broken record on there, but it's like a doctor, right? Eat healthy, work out. It's not
Yeah.
going to change.
It,
Exactly. It works. So even if you guys are bored of hearing us say it, we're still going to say it
yeah.
because it works.
Every time we meet, we'll say it again.
Say it again, and I will try to find new and creative ways to say it, but it'll be the same message.
Yeah, for sure. We can use AI.
Get started, stay investing, talk to your wealth advisor. That is the trifecta, and 2026 will be no different. But Matt and I will be back talking about the markets, giving you guys more perspective. We have our monthly newsletter. We've now made it available on the website. So you guys can go to wealthmore.net and see the monthly newsletter. Matt does a beautiful job of just breaking it down and making it relatable. And then, of course, we come on the pod and share some of it. So if you want to read it, you can read it. Or if you want to hear us talk about it, you can also tune in on the pod. Some other exciting news I want to make sure I share with you guys if you didn't catch it already. WealthMore is now available to all Google employees via Perks at Works. Thank you to our friends at Google for helping make that possible. This is the kind of benefit that I would only get access to when I became an MD at JP Morgan. Sorry for another acronym, but that's managing director. And having a wealth advisor was a benefit reserved for the highest paid employees. And I couldn't be more proud that WealthMore wealth advisors are available to any level of Google employees. We're not gatekeeping. We're not going to tell you once you make it, now we'll help you. No, we want to help you every step of the way. So, guys, feel free to go to wealthmore.net. Google employees have a special offer through Perks at Works, but we also have special offers on the website. So feel free to grab any of those offers and get started. And we heard you guys, the new account opening process, easier than ever. Literally takes 5 minutes. It's 5 steps. We didn't want to make it complicated. We wanted to meet you guys where you are. You pick your advisor, confirm who you are through ID verification, select your plan, answer a few questions so we can match you to one of the 4 portfolios and then set up your payment, and it's really that easy. So
Look,
I don't want to hear any excuses, guys. Go over to wealthmore.net, get started. It's going to be an interesting year, but we will be here every step of the way.
yeah, always a
Matt,
pleasure too. No, always a pleasure to be here and talk with you.
yeah. And hey, today all the world leaders are meeting, talking. I've been literally watching every segment I can. CEOs are out there. I've listened to CEOs of Citi, Gap, you name it. Of course, I love this stuff, but I encourage you guys to tune in, hear what they're saying. It's just great to be in the market, to be a consumer of the content. It'll make you smarter, more comfortable. And hey, you can reach out to us with questions about whatever you hear.
For sure.
Awesome. Well, guys, stay tuned for our next episode. We're also bringing guests, outside guests, onto the pod just to get more perspective and bring other resources so you guys are aware of other tools that can help you. But until next time, this is All the Wealth. Thank you, guys.